Hi, this is Travis Tsukayama. Today we'll talk about 4 tax planning strategies that you can implement using your tax return as a resource. If the idea of taxes gives you anxiety, don't worry, you're not alone. We get questions from clients all the time asking how they can reduce their tax bill or avoid paying more than what is needed to the government. A recent Wallet Hub survey found that 50% of the participants would rather do jury duty than do their taxes. But tax planning can be an important part of an overall financial plan, so it's important to know what your options are. The federal tax deadline was extended to May 17th, so some of you may have already done your 2020 taxes. Today, we'll talk about 4 tax planning strategies you can use and implement using the tax return as a resource. When you get your tax return prepared, one of the first things you can look at are ways to reduce your taxable income. This is the amount upon which your marginal tax rates apply to. One of the ways you can do this is by contributing more to company pre-tax retirement plans, such as a 401k or a simple IRA. By increasing your deferral, you funnel more funds into your retirement plan, which is a plus, and also reduce the amount of income that is taxable for this year. The trade-off is you'll have less income to take home, so be sure your cash flow is in order before doing this. If you don't have a company retirement plan, you can contribute to a deductible IRA. The maximum contribution is $6,000 or $7,000 if you're over age 50 by year end, and this money is a deduction to your income. Reducing your taxable income is especially attractive if you're on the cusp of a lower marginal tax bracket, and by reducing your income can be responsible for a lower marginal rate. We have a tax calculator on our website Learning Center, which you can use to estimate your tax liability that will link below. Having flexibility is an underrated part of retirement planning. It's a good idea to have different types of money in taxable accounts, tax deferred accounts, and Roth accounts. Many people already know the benefits of having money in a Roth IRA. What is not as well understood is the process of converting money into your Roth IRA. The second reason to review your tax return is to check for the possibility of doing a Roth conversion. Keep in mind that anything you convert into your Roth will be considered taxable income for that year. So the question you ask yourself is whether you'll be in a higher tax bracket now or in the future. Sometimes the answer is more obvious, and sometimes it's a toss-up. For example, if your income was lower this year, it makes sense to use up the lower part of the marginal bracket by converting more this year to Roth. On the other hand, if you plan on converting over a number of years, consider converting only the amount that's going to keep you in the same marginal tax bracket. There is a way to take advantage of a temporary market pullback that involves Roth conversions. You can convert cash from your pre-tax IRAs to Roth, of course, but you can also convert shares of your holdings in kind to Roth without having to liquidate them first. This is advantageous because you're converting shares of your stragglers to Roth and paying taxes on their market value with the idea that once they're in the Roth, they'll recover and you can enjoy future tax-free earnings. We need to address the least fun part, which is paying the taxes. Rather than withholding from the conversion itself, you could consider paying the taxes using outside funds, such as from a checking or a brokerage account. The idea is that you're trying to get as much money as you can into the post-tax bucket, so use outside funds to pay the taxes. Now, the third reason to review your tax return is to effectively tax plan regarding your taxable accounts. There are different tax rates that apply to your capital gains that range from 0% to 20%. Now, that may change with coming legislation. We will see. But the idea is that your capital gains rate will always be lower than your ordinary income rate. Here's a simple example. Let's say you have a stock that's performed well in a taxable account. And if you're in the 0% capital gains bracket, you could sell the stock and realize the gain and not be responsible for any capital gains tax. You can then turn around and repurchase the same stock in your account, thereby increasing your cost basis. And you don't have to worry about wash sale rules as they only apply to realized losses. In addition, here's a way to turn your lemons into lemonade. Let's say your losses exceeded your gains. You can reduce your ordinary income up to $3,000, and any unused losses can be carried forward to future years. Although realizing losses isn't the goal, it's one way to salvage value from your portfolio and from investments that didn't pan out. Finally, reviewing your tax return can be especially helpful when it comes to strategic cash flow planning. This is especially important in the years leading up to and starting off your retirement. In fact, one of the big milestones is when you're forced to start taking required minimum distributions from your IRAs and from your 401k retirement plans. Under current law, RMDs begin in the year you turn age 72. But it's even more important to start cash flow planning before you begin RMDs as a way to give you greater flexibility later on. We already mentioned Roth conversions, but for those people in their 70s, you can also consider qualified charitable distributions as a way to reduce your taxable income. Now, this is especially important for those who don't plan on using their RMDs for living expenses. If you can gradually reduce the amount in your IRAs through Roth conversions and withdrawals now, you'll have a smaller amount you're required to take out later. Tax planning is an often overlooked part of the financial plan. Something about taxes makes people want to run the other direction, but the benefits of effective tax planning are worth it. Using the tax return as a resource, we covered 4 tax planning strategies that you can implement. First, we discussed reducing your taxable income through retirement plan contributions, which can be especially helpful if you're close to a lower marginal tax rate. Then we dove into Roth conversions and how to do a conversion in the most advantageous way. Your taxable accounts present a tax planning opportunity as you can determine how to make the most of lower capital gains tax rates and carry forward losses. Finally, we discussed how to plan for RMDs and future withdrawals by adjusting your tax situation today. I hope we made discussing taxes more interesting and palatable. Of course, there are more things that go into tax planning than what we discussed here, but we'll leave the finer detail to a future video. As always, we are here to answer your specific questions. You can reach out to me, Christina, or Les for a follow-up discussion. That's all for now. We'll see you next time.